Thank you for coming. This is the first seminar after COVID in presence, so it's very good and nice to be here, to have a good public. And we will go to YouTube, YouTube channel later on, so please don't misbehave. Anyway, this seminar is by a student of Emilio Barucci that collaborates with us from the Politecnico di Milano, and so I will let Emilio introduce him.
Yeah. Thanks, Tommaso. It's unusual to have two introductions, but that's so. My name is Emilio Barucci. I'm professor of financial mathematics at Politecnico di Milano. And today I'm here with Davide, who's a student of mine and PhD student of mine. Davide is working on a network. We are doing something he's specializing in network application to ESG. ESG in finance, as you know, is a very hot topic, and the problem is to find interesting topics to analyze, okay? Not just to publish papers. And I hope that this is mostly a presentation, a formal presentation about research ideas that Davide would like to develop in his PhD program, in his PhD thesis. And so I leave the floor to Davide. I think you have 40 minutes.
Yeah.
40 minutes.
Thank you. Good afternoon, everyone. So yeah, as I was saying, as Emilio was saying, I'm Davide Stocco, PhD student at Politecnico, and today I'm going to talk about the ESG ratings and their relationship with the financial market and the latest literature that has been produced so far. So let me start with the table of contents. We're going to go through the ESG ratings. So I'm going to give you a bit of knowledge of how they work, what are the main issues, and how they are produced by the rating agencies. Then we're going to go through the literature. In particular, we're going to analyze the relationship between the ESG ratings and the financial market, so the reaction of the financial market to these ratings. Then we are going to see the ESG disagreement, which is a very interesting topic since it creates a lot of issues for responsible sustainable investors. Then finally, I'm gonna talk about the inflated ESG ratings. This is quite a recent topic that has been introduced in the literature. And then finally, I will talk about a research idea that I'd like to work on. So let me first introduce the ESG ratings. ESG stands for environment, social, and governance. These are the three main pillars of each ESG rating. In particular, for each rated firm, we have an analysis of their performance from an environmental perspective. So basically, rating agencies collect data about, for instance, GHG emissions, pollution, the ecological footprint, and the climate change policies that firms have in place. But the list is very long, and I'm not going to go through them all. Then we have the second pillar, which is the social one, and it mainly relates to how the firm acts with its employees and in the society it works in. So we have, for instance, the labor standards, the community impact, the customer responsibility, health and safety, and all the data that concerns the societal part of a firm. The third part is the governance. The governance relates to the board and how it works and the rules of the board. So for instance, we have the shareholder rights, the risk management policies that are taking place into the firm. Is the finance invested here? Great. Then the anti-corruption policies. Also, we have the percentage of women in the board, the diversity, and all this data creates the third pillar. If you, for each pillar, a score is produced, and also you have a general score of the sustainable profile of the firm, which is called the ESG rating. How the Sustainable Investors Act and why are the ESG data important for investors? Well, in Biblio et al. Article of 2020, there is a very interesting list about the main investment strategies a responsible investor can have. The first one is the negative exclusionary screening, which means the universe of stocks an investor can select takes out all the firms that do not achieve a preselected benchmark. Or for instance, you can decide to not to take into considerations all those firms which are not ethical for your perspective. For instance, tobacco producers, alcohol producers, etc. The second one is the positive and best in class. So it means for each, let's say, industry or for your universe, you create a score of your firms and take only the best performing ones. So you create a portfolio with the best performing stocks. Then we have the sustainability themed investing, which relates mainly to a particular goal of the investor. Then impact community investing, which invests in very specific projects, which can be, if you think about the green bonds, are kind of in this class. Then we have the ESG integration, which fully take into consideration the ESG ratings, and then corporate engagement and stock activism, which means just using the rights of your stock ownership. And then finally, the norm-based screening. Basically, this investment strategy is based on international norms in sustainability. So let's go back to the ESG ratings and how they work and they are produced. Let's start reading this picture from the bottom. The rating, this is from Thomson Reuters Eikon. In particular, they select more than 400 data points for each firm. So for each firm, we have more than 400 data concerning sustainability. From these, more than 70 indicators are produced, which means from raw data, you create a first set of indicators to score your firms. And then from this, you have the split into the 3 pillars, environmental, social, and governance, in which some categories, 10 categories in particular in Eikon, are produced. And then from this, you can create the rating score and finally the ESG rating score. What is very interesting is that this data comes from the non-financial reporting disclosures. These kind of documents are produced by the firms, the rated firms themselves. So it's basically an internal report. Already at this point, there is still a lot of analysis and studies going on because these data are quite difficult to retrieve and sometimes are not that objective. But we will see later in the presentation what are the main difficulties at this stage.
Two questions.
Yeah,
Do
sure.
they share the KPIs? So are you able to reproduce the scoring, or they got an algorithm which just...
Yeah, that's a very good question.
So if you repeat the questions, just put...
Yeah, sure. So the question was if you can reproduce these KPIs and the ESG ratings. Yes and no. I mean, this is kind of a black box owned by the rating agency. They produce a lot of public documentation, but the overall method is not clear. Also, for each industry, you have a particular methodology. Because if you think about comparing like the energy sector with the financial one, and you have to compare them on an energy consumption level, it's pretty difficult to create an objective rate. So also at this stage we have a lot of issues. I worked a bit on machine learning to disentangle this black box, but the linear regression model was better. So yes, a lot of, but usually it's just a linear model. It's just weighted average of the data. So I'm focusing about the Eikon data. The scores, as I was saying before, are based on publicly reported data, and they try to measure the firm's performance. The final score ranges from 0, which is the least performing firms, to 100, which is for the best ones. And we will see why this statement is important, because Sustainalytics has the scale which goes the other way around. So 0 is for the best performing and 100 is for the worst ones. And then the scores are based on the industry, the firm's affair, and also the country of incorporation of this firm. Because if you think about the governance pillar, maybe some norms in Italy are different from UK, so you need to be very careful in comparing this data. And finally, Eikon attributes almost 1/3 to each pillar, but you see, it's already here, it's already tricky. I mean, it's 34, 35, and it can change. And also, there are some issues about the ESG rating that are given to the firms, since it has been noticed that they can be changed also backwards in time, and Thomson Reuters doesn't claim it. It's not public. So yeah, we have a lot of discussion that is going on. So let's deep dive into the literature. The first chapter is about the relationship between the ESG ratings and the financial market. And I want to start with this article of Berg et al. Of 22. This article is one of the main articles that you can find in the literature, and they studied how a downgrade or upgrade in the ESG rating affected the stock prices. And they found that there was a negative long-term response of the market to a downgrade, and a weaker and slower positive response to an upgrade. So basically, negative news are more important and are more reflected in the financial market than the positive ones. These kind of changes didn't affect how much the firm invested into improving their sustainability profile, except for the governance pillar, which you think about is the easiest to change because it's a change of norms or change of policies, while for the E and S it's more on the economical side. And finally, what is the main result of this paper is that the ESG ratings are important for the market, and they have an impact on the economy, but still it's limited and slow. How did they achieve this result? They used an econometric model in which they considered the ESG ownership, which is defined as the fraction of the company's share that is owned by sustainable investors, which are explicitly sustainable. And they wanted to explain this ownership through the event, the downgrade or upgrade or downgrade of the ESG rating. So BI represents the event of upgrade, CI of downgrade, and they saw how the ESG ownership changed respectively to this event, which is here in -1, time -1. And they actually saw that if there was an upgrade in ESG ratings, then the ESG ownership would increase, and the other way around, of course. And it's also, there are some fixed term effects of industry level and firm level. The second article is from Pellizzon et al. From 2021, and this is about Sustainalytics, the rating agency I was talking about before, for which now they go from 0 to 100, in which 0 represents the best performing. But it was not always like that, since this measure changed in 2019. Before it was like Thomson Reuters Eikon. So in September 2019, these metrics were changed, but there was not a big news in the market. So the investors were not aware of what was happening. And the Bellitzon et al. Tried to analyze this quasi-neutral experiment, did a quasi-neutral experiment to analyze the response of the market to these changes with an asymmetry. It was related to a positive abnormal change in the returns and also the other way around. So a negative change would affect also the stocks from this perspective. How long did it last? Through the second model that I introduced before, they saw that there were 4 or 5 months of distress, and then it returned to the mean. So the market reacts to these changes, but then the investor realized it was just a change of methodology, so they adjusted their view on the market. The second chapter that I want to discuss is about ESG rating disagreement. So far we spoke about Sustainalytics and Thomson Reuters, but the number of rating agency is way larger. We have, for instance, MSCI, etc., etc. The problem here is that different rating agencies produce different sustainability ratings, ESG ratings. And what are the main channels of these differences? Well, in Berg et al., which is another very interesting article, 22, addresses this point. And they found the 3 main channels of the differences in the production of these ESG ratings. The first one concerns the measure. The measure is just which data you collect and how do you measure that particular data. I will give you an example. You can collect, for instance, the CO2 emissions, or you collect CO2 emissions over market capitalization of the industry. Using these 2 different data can lead to a different rating final score. The second one is the scope. So it's just a difference in the subset of data that you are using. Thomson Reuters Eikon has the broader data set, but then you have also smaller ones that you can find around. And finally, the weights. So how the methodology behind your rating, your scores. In particular, changing the importance of one data to another can lead to a different result. They saw that the most important difference was given by the divergence in measurement of 56%. Then the second one was the scope, so how many data and which data you collect. And the third one was the weights. Basically, the weights concern the methodology, and the methodology is pretty similar among the rating agencies. It's usually a linear model, and it's just a weighted sum. And also, they found a rater effect. A rater effect comes from the view of the rating agencies on the rated agency. So basically, if I think that particular agency is really sustainable, if I have a prejudice on it, I will give a higher final score, or I will change a bit the final score, the expected final score. So this is quite interesting because you have to be very careful on the data that you're using. I will give you an example that you can find in the article. Here you see it's normalized. So the asset for rating of Barrick Gold Corporation in 2014 compared to KLD rating of the same company. So we have the same company, 2 rating agencies, and we compare the difference in the final score. And you can find in green the differences in scope, which concerns mainly the taxes, the resource efficiency. Then we have the measurement, which is the biggest differences, which concerns, for instance, the indigenous rights and the business ethics. And then finally, the model, the weights. So it concerns the biodiversity and their toxic spills. So same agency, same firm, listed firm, different final ESG score. Another article of Gibson, Brandon et al. Of 21 tried to study how disagreement changes the stock's price. So the relationship between the disagreement and the stock returns. They used the Standard & Poor's 500 from 2010 to 2017, and they found that a higher disagreement leads to higher risk premium. So basically, if different agencies have different views on the sustainability of a particular firm, you will get higher return at the end. And this relationship is mainly driven by the environmental dimension. To achieve this goal, they just used a regression model on the total score and then the 3 pillars. And you see that the main driver is the environmental pillar, and also it was adjusted by some economic variables just to clear out the final rating.
Sorry, you mean that investing on firms that are less clearly ranked returns better, give better returns?
Yes. Okay. The clearer the sustainability profile of the firm, the lower the returns will be.
Okay.
Yeah.
How about the volatility of the returns?
Sorry?
How about the volatility of the returns? I assume if there is more disagreement, there's more volatility.
I think that they didn't study that point in this
But they might have a
article, because they used the standard deviation on the ESG ratings, and so they were more concerned on the volatility of the ESG ratings rather than the returns volatility. The last article about in this chapter is from Bibliography et al. From 21. And basically, the first part is similar to the Berg one, and they found 3 main channels of differences in the ESG ratings, which are called in a different way, but mean exactly the same. So the subset of data that you use, the measurement that you have, and how do you measure the data. But also, they provide evidence that sustainable investors use different universes to create their portfolios. And so they found that this disagreement disperses the effect of the ESG ratings. So basically, the ESG rating is not that essential to create a your portfolio returns. And so they didn't find a strong relationship between the ESG ratings and the market behavior. To this aim, they created 2 portfolios, one called ESG, the other one non-ESG. The ESG one is just the subset of the common constituents of 4 indexes that you can find in the market. While the non-ESG portfolio is exactly the complementary part. Before 2004, these results are interesting, but I would say they are not essential for our purposes, since before 2004 there were a few firms rated from a sustainability perspective. But you can see that from 2005 to 2019, you have a positive and significant alpha for the 2 portfolios. But if you short long these 2 portfolios, you will lose that particular alpha, which means that there is no difference into the 2 portfolios from a returns perspective. So basically, ESG ratings do not reflect any particular financial behavior of the stocks. Okay. Now I'm going to talk about the ESG inflated ratings. This is quite, it's a very new idea that came into the literature. It has been introduced by Bams and van der Kroft in their article of this year. I'm going to show you a bit of also the idea, but also how they achieved the goal, their proof. So they state that firms can reduce their cost of capital by inflating their ESG ratings. So they can modify the final ESG rating in a way that I will show you later to also have economical gain. The problem is that the investors do not know, are not aware of what's happening in this case. So there is an information asymmetry framework. And in particular, the socially responsible investors will invest into ESG or high ESG rated firms, but they don't know that these particular firms are not exactly the best performing from a sustainable perspective. So there is this shift from an ESG investment profile to an actual sustainable profile. This analysis was conducted on Refinitiv, on MSCI and FTSE ESG, and in particular they found that the actual sustainability profile of the rated firms is inversely related to the ESG ratings. So basically, the higher your ESG rate, the lower is your actual sustainable profile. This is quite a strong statement, and it has created a lot of discussion. Yeah.
So is it the case that the ESG ratings reflect future expectations rather than past sustainability?
Yeah, that's the point. I mean, the ESG rating, I will show you later their methodology, are now overweighting the future expectation of the sustainability profile of the firms rather than analyzing now how they perform today or the past year. So that's the mismatch between the ESG rate and the sustainable investor interest. And so they stated that these ESG rating investments are less sustainable than the market portfolio itself. So how did they work? First of all, they started from raw data. So the very bottom of the first picture that I showed you in the presentation. They started from this raw data, and they decided to create two particular ESG ratings themselves. So one is related to the promises that the firms do into sustainability policies, and then the other one is the actual ESG profile of the firms. To create so, they use these two equations. The first one states that a firm is better from an ESG perspective than the other if it's better at least to another industry for every ESG data, and for equal for a limited number of the ESG data. And then you can create the rank through this ordering. So they created this rank for each, divided into the industries. They created a rank of the firms for both the ESG promised and the ESG realized. I will show you better the data. So for each industry, here you find the raw data, like the ones that are collected by the rating agency. This comes from Thomson Reuters. So we will have, for instance, policy emissions, emission trading, emission targets, CO2 emissions, etc. You have some categories, and then you have an ESG type. The ESG types are these 6, which are reporting policy, activity, target, controversy, and performance. And they said that the first 4 classes creates the ESG promised performance of the firms. So, like in the policy, you can find in 5 days we're gonna reach this particular benchmark in CO2 emissions, or we're gonna reach this particular benchmark in the number of women in our board. And then you realize is the backward in time one. So you have the number of controversies that you find in this sphere, and the actual performance. So how much energy you use, or how much you pollute, etc., etc. What they found is that there is an actual negative correlation between the realized ESG and the data concerning the ESG profile of the firm. If you look at here, you see that, for instance, the CO2 emissions over assets is negatively related to the realized ESG. So you have a mismatch between the ESG. While if you look at the actual ESG that you can find in the Refinitiv, there is a positive correlation. So you have a very different view on the same firm. And then you can go through the very details of all the table.
Sorry,
yeah.
How can you justify this? I mean, okay, you say that the rating looks is forward-looking.
Yes.
And realized ESG is backward-looking. Okay.
Yeah.
But rating should always check what is happening.
Yes.
So I mean, of course, if you want to do ESG investment, you can also invest in a company that is polluting a lot because you want to improve its performance. I'm fine. But how you justify this negative correlation between realized ESG and rating? How they justify it?
The problem is here, how much you weight these two classes to how much you weight these four. Because if you overweight the promised ESG performance, you will get a higher.
The rating takes into consideration both items.
The ESG rating of Eikon, for instance, takes all the classes. But the problem is that these classes weight more than these two. So the ESG rating is in a way forward-looking more than backward-looking. But if you base your analysis on the ESG ratings on a forward-looking basis, it becomes very tricky because a firm can state, I mean, that in 4 years they will have this kind of behavior. Okay. But then there is the actual performance you see only in the future. So that's the point. Here they just did a linear regression on the 3 pillars over their promised and realized ESG ratings. The results are exactly the ones that we were discussing before. So the realized ESG is negatively related to the ESG rating, while the promised is positively, and then you can see also through the classes, all the classes. But it's consistent. Also, it's consistent among raters and among industries. They did a lot of robustness checks in this perspective. So I'm going to discuss briefly one of my ideas of my work that I want to do, starting exactly at this point. So discussing how this difference into the promised and realized ESG profile of the firm can lead to a financial distress. So basically, if the investors' asymmetry is not present anymore, so there is complete information in the market about the sustainability profile of the firms, how does the market react to this information? So I want to create, as in the Bams and Van der Croft work, these two ESG ratings, the promised and the realized ones, and then working also on the disagreement, so using data from different ESG ratings, so creating a sort of standard deviation, a variability into these ratings. I want to study its connection to the market and to the systemic risk. How to do so mathematically? I want to use the complex network theory. In particular, I want to connect this information either using a single layered complex network and then adding on top of it the information of to the nodes which represent the firms about their ESG performance, or using a weighted multiplex which I can show you here. So the first idea is this one. So we have one layer with all the markets and then I study the market. Or we can create like a sandwich of complex networks in which one layer represents the financial market and the other layers represent the ESG profile of the firms. The financial market will be analyzed and created using the multivariate conditional probability approach introduced in ASTE 2020 to really study the systemic risk of the market related to these ESG ratings. Yeah, and that's the end of my presentation. Here you can find all the bibliography that I discussed today.
Thank you. Questions? I have questions, but somebody else.
I would like to make just a short comment about what Davide has done, just to make one point sorry, explicit. There is very weak relationship between green features of stocks and economic performance. Okay, so both empirically and theoretically. So it is quite difficult that you find an alpha related to ESG or no ESG investment. Things are going to change because we have in the market a strong, let's say, demand effect. So the fact that many institutional investors are changing their attitude towards this type of investment, this type of stocks, would affect, of course, the stock price. This is the first point. The second point that I would like to remark about what David has shown, and I think that his idea, and I think that is very interesting to develop, is somehow ESG is not observable. The rating is a proxy that you have difference of opinion about it. And we know in finance that when we have difference of opinion about something that is not observable, you may have volatility. I simplify. Okay, so the phenomenon that difference of opinion leads to extreme movements is well known and so on. So this is the main reason why ESG inflating ESG can be a driver of, let's call financial instability. I will say not financial instability, volatility or whatever, let's call it. What is interesting is that, as David is saying, what we observe is we observe more or less a little bit of a phenomenon of manipulation. So firms are manipulating this promise, the ESG, to affect the market. So I think that investigating whether or not this behavior may have an effect in terms of systemic risk is too extreme, but I would say volatility, strong correlation, and so on, I think is something that is worthwhile to work, and I encourage Davide to work on it. I don't know, of course, what could be the instruments to analyze. Davide has seen your paper, Tommaso is referring to, but this is the main idea. Then how to measure systemic risk through network models, I think is an open question. I'll stop here.
Yeah.
Thank you for the presentation. Coincidentally, yesterday I was also in your presentation related to the ESG. Actually, an industrial professor at UCL, working also in KPMG, presented it. You're working on a product called KPMG ESG IQ, and what I understood from that presentation was that these rankings are also significantly comprised from the self-reported parameters. So the firms are just self-reporting. It is very related to the policies part.
Yeah.
As far as I understand from the auditing part, it is about more saying, are you compliant? Do you have these policies? I have these policies. Okay, then you are perfect. It's like that. So what they tried is using NLP to extract from various data sources, including the publications, official publications, to get ESG related signals and then direct them to some factors. These factors can be inspected and like, why have you given this 80? So when you look to that factor, you will have the chain of reason till to the publication. It says there's a report and it says this. So I just wanted to name it and we might find something useful. And I think they have a very vast data set. They use this Refinitiv, Reuters, Bloomberg, pulled them, added these NLP chains, and then they make their own data sets. So it might be useful for your case.
Yeah, a lot of sanity check on the raw data is done already from the rating agencies. But I will tell you an example. The CO2 emissions are split into 3 classes, scope 1, 2, and 3. Scope 1 relates to the direct production of CO2. Scope 2 is the indirect production through the use of energy, through the use of electricity, etc. Scope 3 is about the CO2 emissions of the overall supply chain of your products. Scope 3 is a huge problem in these ratings because each firm states their own scope. So yes, I see the point of using NLPs and it's very interesting, but yeah, we need a broader and more objective taxonomy behind these reportings. Otherwise, we're not gonna go anywhere. Yeah, thank you. For the comment. Yeah.
Yeah, quick question. I'm interested to know why you want to use undirected graphs in your modeling. Is it really visualization? Is it to try and understand secondary effects between interconnected nodes? Or are you planning on doing some kind of prediction, and if so, what?
No, actually I was thinking about also using direct, especially for the model of Aster, yeah. Because maybe seeing the channels, I mean, you can create some classes of ESG disagreement and ESG inflation and see how each class influences the other. So yes, this is an open comment. I still need to think about it. Yeah, thank you.
2 questions. One
Yes.
very quick. I mean, these data are organized or just a narrative? I mean, so there are
No, you can't
numbers.
download. Yeah, you can't download data.
So there is a table with numbers.
Yes. Yeah, for each firm you have the number, like the number represented CO2 emissions,
Yes.
the number, Boolean number for the
category and a
policies.
list of
Yes.
numbers.
Yeah,
Yes.
and mostly you have you cannot take the absolute level of some, for example, emission. You mostly can also normalize by either the number of people working the firm or the number of revenues.
Yes.
And of course, so in this number, there are numbers that are well, the one that you realized and the not realized. And okay, now I understand it. A different question. Given that Pellizzon, if I remember well, demonstrated that there is a pressure on price, so if you go up in ranking, your price go up. Why then the investment are not affected by the ESG ranking or so?
This is a great question. And also, there is another paper of Berg which states that Eikon changes also backward in time the ratings. So I think that the asymmetry in the information of the investors and this huge volatility in the ratings affects the real impact of the sustainable investments. That's why we need more
Also,
data.
as an answer, they also show that the price go back, so which means that it might be
Yes.
during your investment it becomes irrelevant.
Yes, it can be also limited in time.
And one suggestion, but just to say, is that the disagreement being related to more productive, but more to better performing firm, it could be related somehow indirectly with this idea of complexity. So the fact that I mean, a firm that does not have a very simple production scheme might be actually more competitive in the market, but of course it's much harder to define its rating just because it depends on what you look at.
Yeah, to quantify their profile.
So yes, that's true. More diversified firms might be more.
Thank you.
Interesting.